All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to break down SPX as well as TLT, take a look at the bond market and stock market. But before we do so, there's lots of data that I want to cover, such as bankruptcies. We're going to talk about consumer sentiment, look at inflation expectations, all right, and really just cover a lot of important data that I think you guys should notice. We also have to talk about the bond market volatility, consumer staples just being sold off, tremendously lately. We've seen, things with the Magnificent Seven that we really need to cover with you guys. We'll go over some of the Magnificent Seven scripts. All right. But as always, the content provided on this channel is for informational purposes, not financial advice. If you're new to the channel, I started this newsletter here, Investment Intelligence, giving out free trade ideas as well as free valuable finance content. Okay, you can see, highlighting the conditions on this trade idea here and how that trade idea turned out. This was another one on SWK, Stanley Black and Decker. All right, highlighting, where the price could go after the rising wedge formed here. And that trade also played out very nicely. All right, if you want access to all of the different trade ideas, you can join the Investment Intelligence Discord using the link in the description. Otherwise, you can just sign up for the free newsletter. And if you ever feel like you want a one-on-one session, such as a 30-minute or 1-hour session, you can do that through the Ko-Fi page by clicking on the commissions tab, and you can book those sessions directly through Ko-Fi. You can also click on this buy a coffee button if you ever want to buy a coffee for me, just as a simple way for saying thank you for all of the free valuable content I put out for you guys. Now, let's get into it here, and we're going to start off with bankruptcies. So 2023's total of 516 bankruptcies already surpasses the total filings seen in calendar years 2021 and 2022. And 2023 is still not over. Okay, this is actually a data set through September. October is not officially over yet as well. So just in the first 9 months of the year, we've already seen more bankruptcies than 2021 and 2022. Now, bankruptcies are hitting companies with high levels of debt and low earnings in the consumer discretionary, healthcare, and industrial sectors. Why is it hitting these companies? Well, companies with high levels of debt right now are being absolutely torn apart because of the rapid acceleration of the Fed funds rate and the rapid acceleration of treasury yields and interest rates in general. And again, you're seeing this affecting stocks in consumer discretionary, healthcare, and industrial sectors the most. Okay. The headline consumer sentiment gauge plunged to 63, all right, from 68.1. This was led by a big drop in expectations. So that's basically what we're seeing here. The red line is expectations, and then the blue line is going to be consumer sentiment, and the green line is economic conditions index. You can see a big plunge in all three of those. Obviously the market has been dropping a lot lately too. But most investors believe the end of the bond market sell-off is near, right? So there's actually a survey here, and they're saying, where do you see the U.S. 10-year U.S. Treasuries at year end? Okay, and most of them see below 5%, okay, at the 4.5 to 4.75 region. As treasury yields continue to go up, that's going to result in the bond market selling off more. And so most investors seem to think that the worst is over for the bond sell-off. Now, 1-year inflation expectations jumped to 3.8%. This is the highest level since May, and the 5 to 10-year expectations moved back up to 3%. So we have the 5 to 10-year in orange, and then we have the 1 year here in blue. And basically what we're seeing is, inflation expectations starting to tick back up. Okay. And this is something that people are going to tell you could potentially keep, that higher for longer narrative going from the Fed, right? They're very focused on inflation. This is just the expectations. Okay. But this is definitely something you're going to want to monitor. Now, equities are negatively correlated to the MOVE index. Now, if you're not familiar with the MOVE index, okay, that is basically the VIX for the bond market, all right, the MOVE. All right. Now, the final bucket is larger to reflect a lower number of observations. The number of observations in each bucket are at the top. Okay. And so, what we're looking at here is going to be the average weekly equity performance of the S&P 500 at different MOVE levels and buckets. Okay, and so you can see when it's below 50, when it's below 100, when it's below 150, below 270. These are the number of observations right here. Okay. And you can see the performance, all right, of the equities here. We have the average here in blue and then the median in lighter blue right here. All right. And equities are basically negatively correlated to the move index, right? And if we actually take a look here, okay, we have the move in white. And then we have the SPX here in red. All right. And you can see really, if we go back to this level back in 2020, once we get above this level here on the move, you can see that that's really when we start to see some pain in the stock market, right? This is our crash in 2020, right? The COVID crash. And you can see the move index was extremely elevated. We have that large move to the downside, and the stock market sell-off really started to, become official, I would say, once we got back up above that level again. You can see in early 2022, we made those, those highs. And once we got above there, it was a strong downtrend, and we've remained elevated. The move has remained elevated this entire time. And look at the recent uptick in the move index, and you can see again that sharp sell-off, right? So, you have the initial lower high here, just like you had the initial lower high here as well. And then you see the rapid acceleration higher in the move. Okay. And, that's exactly what we're seeing again, where we're seeing we make a lower high, then a rapid acceleration in the move, and the stock market continues its downtrend and continues to head lower. Now, consumer staples was the most notionally net sold U.S. sector on the prime book this week. Notional short selling was the largest in 3 months. This is the 98th percentile versus the past 5 years. Okay. And so as this goes up, this is short selling. All right. And as it goes down, this is short covering. Again, we're just seeing massive amounts of selling, okay, in consumer staples. We've seen it across many sectors, such as utilities as well. If the S&P 500 was entirely comprised of the Nifty 7, the SPX would be trading at 8,881. If it was just microcaps, it would be 3,365. If it was just long bonds, we would be at 2,212. Okay. So, the MAG 7 is basically the Nifty 7, right? Okay, that's going to be here in purple. And you can see the outperformance of that compared to everything. And then the government bonds, all right, so basically long-term treasury bonds is going to be the green line here. And this thing has just been in a brutal bear market, right? The bond market has been just in a complete massive sell-off. And it's it's been very brutal, right? That bear market is still continuing to go. We're still making lows and things like TLT, and we're trying to see if we're going to be forming a bottom, but for right now, it still seems like things are uncertain, and it's possible TLT can continue going lower. Now, the Magnificent Seven was almost 30% of the S&P 500 market cap here recently. And that's basically what this graph is showing you. And if you take a look, last time we peaked around those was right at the beginning of the bear market in 2022, just before the bear market happened. And we're back at those same levels here again. Now, this is the Magnificent Seven, okay, up here on top. And then this is the S&P 500 minus the Magnificent Seven. Now, this is actually, kind of a script that I have in Thinkorswim, right? And this is one of the many flexible grids that's actually available to the members in the Investment Intelligence Discord, right? I have a tab here called Flexible Grids, going over many of the different charts and flexible grids that I use in the videos and share with you guys. You guys will have complete access to all of these. And being that they're flexible grids, it's very easy. All you have to do is click on it and it's already set up for you, and you can tweak it however you want from there. So, if you enjoy this type of content, you want access to, some of these flexible grids, as well as the other data and scripts and different things like that in the Discord, use that link in the description to join. Okay. Now, this is the SPX daily chart, and I know this may look like a bunch of scribble, okay, but I want to highlight essentially some of the different scenarios in the market right now, right? So we have a larger count here that we're going to start off with, a 1, 2, 3, okay, 4, 5. Now that is the bearish count, okay, and that would take us to 3,800 on the S&P 500. Okay, so for all you bears out there, this is the scenario that we could potentially be in right now. heading down to 3,800 on the SPX, right? And if you're a little bit more bullish, what you're looking for is you're looking for this to actually be the end of a 5-wave cycle, all right? And you're going to look to see if we can get some type of bullishness and start making higher highs out of here, right? You can see the downtrend is still intact, making lower highs, lower highs, lower highs, lower lows, and lower lows still. Okay, we've also cracked through the 200-day moving average, which is this purple line right here, or I'm sorry, this yellow line right here, and we're trading below the 200-day moving average. Now, if this is the more bearish count, okay, and we are in wave 3, all right, wave 3 is typically going to be a 5-wave move, okay? So what does that mean? Well, here's our wave 2 top up here, and then we got 1, 2, 3 down, 4 down, 5 down, okay? So this is the completion of our wave 3 would be somewhere in between 4156 and 4100, okay? And then you would be looking for an ABC correction to the upside for wave 4, potentially taking us back up to the 4268 area, roughly 4200 to 4268 is where you would be looking for a retracement, an ABC type structure to the upside. And then we would actually get another 1, 2, 3, 4, 5 down to take us to that 3,800. Okay. Now, the other scenario again that I mentioned is that this is our 1 down, 2 up, 3 down, 4, and then 5 completing this, right? And we would actually look for some type of more impulsive move to invalidate the bearish structure here and look to potentially start making some higher highs, getting to that 4406 level. Like I mentioned, creating some higher highs and starting to create some higher lows. That's going to be a little bit more of the bullish case, the bullish scenario. Either way, even if things go bearish or things go bullish, it seems like the S&P 500 is going to be due for a bounce soon. The big question is going to be whether or not it's a dead cat bounce to continue going lower, potentially to that 3,800 region, or if we're going to get a break of our downtrend and start to finally create some higher highs. Now, when it comes to TLT, okay, we've been talking about an $80 price target on TLT for a while. This is a weekly chart, so this is a pretty macro chart. This goes all the way back to 2020. So, TLT has been in a bear market for 3 years essentially, and you have 1 down, 2 up, then you have your 3 down, and our wave 4 was this triangle pattern right here, okay? Basically a giant bear flag, and it confused a lot of people, in this time period, and there was a lot of people who went in here or missed this entry and started buying up here. And if they're still holding, they're underwater massively. But $80 was the price target for TLT for this wave 5 move to the downside. And we still may hit those levels. Okay. TLT has been finding some support around 82, which there's, support from the past. All right, from a long time ago, right around that 82 level. And we are finding some support there, but if we end up breaking that 82, ultimately I think we can come down to $80, maybe even $78. It really just depends ultimately on supply and demand. Okay, at the end of the day, the bond market is facing a supply and demand issue. And so investors in US bonds are demanding a higher yield to buy US debt. Right. The reason being is because there's so much supply. The 3 biggest buyers are not there for us. Okay. And those 3 biggest buyers are going to be the Fed, right? So we have quantitative tightening right now versus quantitative easing, meaning that the Fed is not coming in and buying in US bonds and US treasuries. You have China selling massive amounts of US treasuries, and you have Japan selling massive amounts of US treasuries. Those are typically the US's, 3 biggest buyers of US debt and US treasuries is going to be the Fed, China, and Japan. And we don't have those right now. So from a demand standpoint, there's not as much demand. And then there's also a massive increase in the supply of US treasuries, especially after the debt ceiling deal was, released just this week on the 7-year treasury note. I think they auctioned off like $38 billion worth. And while we have seen billions and billions and billions of dollars, flow into things like TLT and flow into the bond market, remember, that was just one single day and one auction for the 7-year treasury note was like $38 billion. So, they've already flooded the treasury market with nearly $2 trillion this year alone. Okay, and they plan to continue flooding the treasury market, until further notice. And what's really crazy about that is that, again, we don't have the three largest buyers, the Fed, China, and Japan, to buy up these treasuries that were flooding into the treasury market. And so for that reason, that's been a huge factor in why we've seen this massive sell-off here in TLT. Basically ever since the debt ceiling deal happened, right? I mean, look, this is April right here. Things weren't looking too bad, right? And then we start to really see the effects of, the massive amount of treasuries that we're auctioning off, and it continues to push TLT lower. Now, that's it for today's video. Don't forget to sign up for the free newsletter, okay? Completely free to you guys, using the link in the description, okay? You can join the Discord using the link down below, so you guys can see some of the trade setups that I'm looking at to get these, really nice returns trading options, all right? You can use the Ko-Fi page, come on here, click on the commissions, and book a 30-minute or 1-hour session. If you guys ever feel like you need that one-on-one personal touch, and maybe reading or watching the videos sometimes isn't the greatest way to learn. Everybody learns different and at a different pace. So, some people enjoy that one-on-one interaction. That way they can ask questions and, figure out things that they don't necessarily understand. So you can do that through the Ko-Fi platform. The link to join the Discord is in the description, as well as the link for the free newsletter.